Hello and welcome to this Sunday, April 7th, 2024 edition of Earnings Beats Weekly Market Recap. I'm Tom Bowley, Chief Market Strategist here at Earnings Beats, and it's a pleasure to be with you. I plan to just take a look at the action that happened last week, give you my thoughts, and maybe take a look at what may happen in the week or a couple weeks ahead. If you do like this video, you like the content, please give us a shout out below, give us a like, subscribe to our channel. That really help us a lot here at Earnings Beats. Also, feel free to leave a comment, not just on the stock market, but hey, it's Masters Week. So if you got a pick for this upcoming week, I'd love to hear it. I'll try to remember to give you, I got a little bit of an upset pick maybe for this week, but I'll share that later in the comments. All right, let's go ahead and take a look at what happened last week. That's where I usually like to start out. And as you can see on this particular chart list, I've got the six of the key indices that I like to follow. The first, you can see NASDAQ actually was the leader last week. All the major indices were lower, but the NASDAQ dropping about 0.8% was the best of the six I'm showing here. S&P 500 down just under 1%. Dow Jones down almost 2%, 1.8%. Same goes for the S&P 400 mid cap. So this is an area of the market that had been doing very well recently. We did see a little bit more selling in the mid cap area. The Dow Jones Industrial Average finishing down 2.27%. And then the Russell 2000 dropping almost 3%, 2.8% last week. So it was not a very good week for the small cap. And I don't know if I mentioned, I don't know if I said Dow Jones Industrial Average or Dow Jones Transportation. Anyway, in that third spot was the transportation index. Moving on to the sectors last week. This is how it was summed up. Energy, big winner last week. We've seen crude oil prices jumping quite a bit. Energy tends to be very volatile. It goes through periods where it's really strong. Then it goes through periods where it tends to underperform and lag pretty significantly. Right now, we're in one of those periods where energy is extremely strong. Like I said, crude oil prices have been going up, and many of the energy names have been following suit. Last week, energy gaining almost 4% on the week. Really big move. Communication services gaining a little bit more than 1%, and that was it. That's where you see the two major leaders of the market. There were only two sectors that were up for the week. Those were the two. Meanwhile, if you move down toward the bottom, you'll see healthcare, real estate, consumer discretionary, and consumer staples. So both consumer groups down below, dropping anywhere from about 2.6% to a little over 3%. So these were the areas that were weak. Notice three of the groups, staples, real estate, and healthcare, all considered more defensive areas. So yes, we pulled back, but it wasn't the big names. It wasn't the big aggressive areas of the market that we're seeing that sell-off. And that should at least be considered as a somewhat positive signal from last week, even though we did fall back. I want to talk about a few areas of the market that I think could be maybe ready to make a move. I wanted to point out gambling stocks. If you notice the high back in July before the correction in 2023, we've gone all the way back up. We've made it back into this range. You can see on Thursday, we had a breakout in hand prior to a Fed meeting or FedSpeak, if you will. And we're going to talk a little bit about that in just a minute. But we had a big move up, had the breakout in the gambling stocks, and we came back down. But this is a group that if we can continue to trade above that 20-day moving average and then make a definitive breakout closing strong, I think this is a group that could do well. So think about possibly individual trades in those areas if we can see that breakout and continuing move to the upside. The other area I wanted to talk about just for a minute was the furnishings area. So these are both two areas within consumer discretionary. You can see, though, that we made the breakout on furnishings, taking out the highs from back in July of 2023, and then also double top from earlier in 2024. Actually, the first one was in December 2023. But you can see the first couple months of 2024 really struggling to get through these prior highs. We finally did so to open March, went back, put in a higher low, held that 50-day moving average, put in another higher high, and now last week had a little bit of a rough week, moving back down, testing that 50-day again, and currently with higher lows in place. So this could be an area where we see furnishings potentially launch again. This would be an interesting stock maybe to keep in mind, or area of the market to keep in mind as we head into next week. Another area of the market I want to talk about was internet. And I've talked about this before recently. Don't know if you've seen it, but I just wanted to point it out in case you haven't. Internet stocks, we are into the sweet spot for internet stocks relative to the S&P 500. So if you're looking for areas that typically outperform the S&P 500, internet is one of those that seasonally does very well now through July. So if you look at this chart, what I've done is I've gone back and I've pulled up the last 12 years. That's what this slider does down here. You can grab this, move it around. You can go back more than 12 years if you want. And there's going out all the way to 20. I could just look at the last 3 or 4, but I did 12 for a reason. 2013 is when we started this secular bull market. And so throughout this secular bull market, which I believe continues and is continuing, I want to know what areas are outperforming or how these groups tend to perform throughout various times of the year throughout this secular bull market. Internet stocks, if you look, April through July, this is the average return. I'm going to maybe try to make this a little bigger for you so you can see it. But here it is. You can see this is the average outperformance of internet over and above the benchmark S&P 500 each month. Clearly, January's been the best month. I'm not going to argue that. The problem with January is you have a couple of underperforming months after January, and you have a couple underperforming months before January. So it literally is just January standing alone. In this case, as we start April through July, these 4 months tend to be very, very strong. April averaging outperforming the S&P 500 by 1.3%, May 2.6%, a little bit of underperformance in June, 0.5%, and then July is 3.2%. If you add those 4 months up, that's 6.6 percentage points of average outperformance during these 4 months that just began. So I think that's all pretty good information to have. Also, notice that each one of these bars, this is the percentage that the internet group has outperformed the S&P 500 in these various months. So for instance, internet has outperformed the S&P 500 2/3 of April's over the last 12 years. May, almost 2/3. June, more than 50%. And July, almost 75%. So the odds clearly are with this group outperforming the S&P 500. It's important to know because there have been some stocks that have been struggling in the internet space, namely Alphabet or Google, starting to show some relative strength. This is the time of the year when internet tends to go. So stocks like that, be at least on the lookout. You may see some strength coming in that area over these next 3-4 months. All right, I want to talk a little bit about the S&P 500. And you'll see, first of all, from the daily chart, we actually took a pretty big hit on Thursday. Big red-filled candle. That's a lot of selling from open to close. Opening near the high, closing near the low. We actually saw an uptick in volume. That's not generally a very good sign to have those kinds of moves. A lot of times you'll see additional weakness or maybe just sideways action following that type of distribution. You can go back here to the top at the end of July. I mean, very similar type candle. That actually kicked off a 3-month correction. I'm not expecting that. But I do think we could go back and possibly get to the 50-day moving average. I've been talking about that for a while. At the low last week, we were maybe only about 1%, 1.5% from being there. So it's not that far away. We could see some additional weakness. But anyway, just wanted to point out that daily candle. Now, when I see the market go down, I always like to look under the surface, look under the hood to see really what's going on in the market. And if you've been following, or if you were following closely last week, you would know that there were a lot of Fed officials that were out doing some of that little yapping. Never a good thing. Market always looking for any kind of nuggets of information. And unfortunately, they got some last week. So on Wednesday, Fed Chief Powell said basically the same thing he said at the Fed meeting from a couple weeks ago, 2.5 weeks ago. He said rate cuts are coming. It'll be later this year sometime. Still expecting 3 rate cuts. Nothing changed. So that was good. And you kind of see Wednesday was kind of a ho-hum kind of a day. Didn't really do a whole lot. Went up in the morning, came down a little in the afternoon, finished slightly higher for the day. Thursday, this is Thursday's action. I think you can see probably a little different tone in the afternoon. A lot of selling picking up. Volatility index exploded. What happened? Well, I'll tell you what happened. Minneapolis Fed President Neil Kashkari at 2 o'clock made a statement saying that there's no guarantee that there are going to be any rate cuts this year. Now, it's a good thing I had like 3 days, excuse me, to calm down, because Thursday afternoon I was not very happy at all. Partly because I was long and losing money. I mean, obviously that'll do it. But again, you try to take the Fed at its word. Starting with Bernanke years ago, probably back in the 2000s, up to about when I think he left in 2013 or something like that. Anyway, throughout his term, one of the things he stressed, and what the Fed continued to stress since then, was being transparent. They wanted the market to kind of understand what they were thinking and seeing and so forth before it happened, so that there were no shocks to the market. Well, I can just tell you that based on this Fed, I don't think they got the memo. Because you've got the Fed chief, Powell, on Wednesday saying everything still looks fine as far as the rate cuts, looking at probably 3 of them. They're going to be later this year, blah, blah, blah. Same thing he said 2.5 weeks at the Fed meeting, 2.5 weeks ago at the Fed meeting. A day later, Minneapolis Fed President Neil Kashkari comes out and says, I don't know if there are going to be any rate cuts. There may not be any rate cuts this year. Not sure what these two, whether they're on different planets or what, but the whole idea, having Fed chiefs go out or not Fed chiefs, but Fed presidents and so forth, going out and speaking, is just kind of spreading the word, normally spreading the word of the recent meeting. In this case, Neil decided, hey, I'm going to go a little bit off script, and I'm just going to throw this monkey wrench into the market. And you can see the impact. I mean, look at all the other days, pretty quiet, mostly sideways action. Look at Thursday, big sell-off. Now, again, you can either take him at his word and think, okay, valuations are coming down. I mean, if you're not going to raise rates. Now, again, he's just one of the voting members of the Fed. So, he's just one vote out of 12. But when you've got a Fed official thinking this way, you got to at least take it into account that, hey, maybe things are not quite the way they were. But again, Powell came out on Wednesday and said everything was the same. Thursday, apparently everything changed, according to Neil. So what do you do with this? Well, I ran another chart. And again, I like to take a look at what the message is, what message is being sent by where the money is going. So let me just tell you that if we don't get another rate, or if we don't get rate cuts this year, after the Fed has kind of telegraphed that we're going to get them, what you would see, number one, is rates staying higher longer. What does that do? Well, valuations they're based on where we believe interest rates are and where they're going, and the economy. It's all about interest rates and earnings. Earnings have been pretty strong. We expect them to continue to be strong. But if you change the interest rate outlook, that completely changes the valuation in the stock market. And that's what this action late in the day on Thursday was saying, that, hey, we got to take into account another risk factor. What if we don't get any rate hikes? Or excuse me, rate cuts? What if we don't get those 3 rate cuts that Fed Chief Powell's been promising or talking about anyway, alluding to, whatever you want to call it? Well, we got a little glimpse in the afternoon. But what I found really interesting is notice the S&P 500 went down lower than it had been earlier in the week. Clearly, way below the earlier lows. When I looked at some of the key ratios I like to follow, the QQQ relative to the spider, so the NASDAQ, which is full of a lot more growth stocks, that index has certainly got a lot more growth orientation to it than the S&P. So you would think the lack of rate cuts would significantly alter the relationship QQQ versus the S&P. Yet it held the lows. Price on the S&P went lower. QQQ versus the S&P never took out that intraday low, the relative low. How about growth versus value? IWF versus IWD. I would have expected this to have fallen apart. What happened? Went down, but never got close to that low from back on Tuesday, that relative low. So, and then, by the way, the very next day it was back up to a high for the week. So didn't take long for the growth areas of the market to move right back up. And we had a non-farm payrolls report that came in stronger than expected on Friday. And again, if you're telling me that, hey, we're not going to have any rate cuts and that inflation could still be a problem, I would say, uh-oh. I mean, if we have a big non-farm payrolls report, that could just add to the inflationary pressures. I would expect the stock market to take a bigger hit. Instead, we came out with a number that was more than 50% higher than what was expected for non-farm payrolls. And this is what we got to the upside. Market went up. Well, relatively speaking. Also, the absolute, there's the S&P 500. We went back up on Friday. Even though Neil seems to think we still have an issue with inflation, and we got a much higher than expected non-farm payrolls report, which would add to inflation expectations potentially. That's not what was happening with the money, though. Money was telling us something else. XLY, XLP, consumer discretionary versus staples, higher. Hey, if there's an inflationary issue going forward, more than what we're projecting right now, I would rather be in staples than in discretionary. Yet, when we pulled back, we held that prior low, and we actually went up on Friday. XLK, technology versus the S&P 500. Wouldn't you think technology would go to a new low? Higher inflation expectations would certainly have you selling technology. Didn't happen. Held that low. Semiconductors continued to drop. That was the one area, and I think that group, just because it made such a big run, probably still looking to consolidate a bit. Really didn't bounce back that much on Friday. So I just think right now that group's in a pause mode. I'd be looking at other areas to trade. You can build positions in semiconductors, but you're probably going to have some patience. Software, though, didn't go down to the lows. And look at internet. I mean, semiconductors, software, and internet, those are 3 areas that I just think of as being, really aggressive. Maybe we could throw in those broadline retailers, maybe the autos. They've been kind of more aggressive, especially over the last several years. Anyway, these are 3 that I like to follow. All 3 of them. I mean, internet went back to a new high Friday morning. Software right near the high later in the day on Friday. And semiconductors, like I said, not exactly roaring back to the upside, but that's a group that probably could use a little bit more sideways consolidation. So I'm not seeing the impact. I'm not seeing money rotate the way you would expect if the market was as worried about interest rates and inflation as Neil Kashkari is. This is telling me, don't worry about what Neil said on Thursday. How about the bond market? So you got the bond market, which was going up, setting a new high earlier in the week. And then you come out with this story on Thursday with Neil saying inflation, we don't know, might not be able to lower rates because of inflation. Got to see it coming down more. I mean, if I was worried about inflation, what would I do? I would sell bonds, which would send the yield higher. I don't want to be in a 4.5 or 4.25% 10-year treasury if I think inflation's going to go up. I mean, right now, you've already got inflation sitting, I don't think it's like 3.7 year over year. That's the annual rate of core CPI. I mean, if we think that's going to go up, what the heck would I want a 10-year treasury yield for at 4.38%? I'm going to make nothing. My real return when you strip out inflation is almost zero. And if inflation might go back up again, I could be looking at negative returns. Right. So why did the bond market react the way it did? Why were folks buying bonds? Look at this chart. So here you've got the 10-year treasury yield from 2 o'clock to 3 o'clock going down. The yield on the 10-year treasury yield was, or the yield on the 10-year treasury was going down, meaning that money was going into bonds. Folks were buying bonds. Again, makes no sense if you think inflation still got a problem. So even though Neil had his little moment in the sun, made a name for himself on Thursday afternoon, I think both the bond and stock market said, stop it, Neil. You're not making any sense. And quite honestly, even Fed Chief Powell, as crazy as he's been over the last couple of years, kind of said the same thing as the bond and the stock market. It's like, Neil, where you been? Get on board. We may have some temporary issues with inflation, but we're going down. And that's what Fed Chief Powell said on Wednesday. He said, I feel confident that the core CPI will continue to move lower toward their 2% target. So anyway, cost a lot of people a lot of money. But in the end, I really don't know that it is that it really matters much. All right, last thing I want to show you today, and that is the consumer price index. So here's the monthly actual value of the consumer price index each month since 1974, going back 50 years. What I have below here is the 1 month rate of change. And you can see when we've got, and this is the 12-month rate of change, when we're down near 2%, you can see where the monthly CPI tends to live, between 0 and a rise of 0.4. That's where we tend to live. We'll have some readings go down at 0 or close to 0, and we'll have some readings that go up to 0.4 or close to that level. And that is basically what keeps us in this 2% target range. Now, with the pandemic, of course, the first thing we saw was prices going down. And prices were going down because demand fell off the chart. There was no demand. We shut everything down. And then when we came back out of shutting everything down, demand soared. And it took a while for supplies to build back up. So that's why we had this move to the upside. Most inflation that we've had to deal with in this country has dealt with, it's been because of a demand problem. I think this one was a little different in that it was a supply problem. It was more on the supply end, shortages. Demand, yes, it picked up initially, but in the end, it really was more about shortages and catching up with demand. And so anyway, we saw that big spike, but look at the last 3 years and tell me, is this trending up or is it trending down? The monthly readings, what is going on here? Well, if you can't interpret that as a downtrend, look below. Look at what the annual rate of inflation, at the core rate of inflation at the consumer level. It has been going down almost every single month for probably 18 months. I mean, at some point, maybe we'll get a little bit of a blip. Look at where we have now been with the monthly CPI, between 0.2 and 0.4. If inflation's coming under control, and I believe it is, we're going to actually start to see a couple of these readings go down below 0.2. And if that happens, this drops, it'll be into the twos in no time at all. Probably, I'm going to say we're in the twos probably over the next 3 to 4 months. And as the Fed sees that happening, they are going to cut rates. I believe the rate cut's going to happen in June. I don't know if they're going to do it at the May meeting. I'm still thinking maybe June. But there are 6 meetings left in the year. I believe there's 6. And Fed Chief Powell says 3 rate cuts are coming. There's only 6 meetings. I mean, if they don't start in May, they're going to have to be starting pretty soon. Anyway, I've kind of thought it's going to be June all along. I think that's when we get the cut. I think in the May meeting, they start to point toward the June meeting as a possible rate cut. That's what I see. Anyway, that's all I got for you this week. I do appreciate you tuning in. Please like the video, hit that subscribe button. We'd love to have you join as a subscriber here. Also, I'm going to be putting together another video taking a look at individual stocks. Probably going to be calling that the Fab Five. So check that out. Maybe Google or search that on YouTube later today or maybe tomorrow. But I'll be giving some stocks from last week, also some stocks and setups in the week ahead. So check that out. Anyhow, everybody have a great rest of your weekend, and Masters coming up this week. Can't wait. Happy trading, everyone.